Let's focus on the pharma sector now. Ekta has moved to the big wall with an interesting explanation on the market of ibuprofen in India. Remember, this is the common painkiller, but why is this one in pain now, Ekta?
Well, ibuprofen, the common painkiller, has seen a slump in demand in the past 2 years and the market is still recovering. Pure play API company Solara Active's pharma stock has corrected over 70% from its 52-week high. Now, one of the major reasons for the correction has been weak numbers, which was impacted by sales of the API used to manufacture the painkiller drug ibuprofen. Solara has one of the largest ibuprofen manufacturing facilities in the world. It supplies to regulated markets with customers going back 10 to 15 years. The company was on its way to commission its new facility in Vizag, which would nearly double its capacity for ibuprofen, along with backward integration plans. That is, to produce the raw materials. This would make Solara one of the two players with scale and integration for ibuprofen. However, FY22 saw the company's ibuprofen business hit by headwinds such as price pressure as well as low demand. So much so that it decided not to use the Vizag facility for ibuprofen but make it a multi-product facility. The ibuprofen market was estimated to be growing 6 to 8% year-on-year as of Feb 2021. However, demand for ibuprofen was hit, especially during COVID-19, in regulated markets. The reason for the demand being hit were fewer people were falling sick as more people stayed indoors, and interestingly, there was conflicting claims and reports indicating that paracetamol, which is another type of painkiller, was a safer drug to use than ibuprofen for COVID-19 patients. What then happened was that demand was hit, which resulted in inventories being built up for companies that either manufactured and or sold the final ibuprofen drug in the market. That is, there was a surplus of capacity of ibuprofen in the world. Solara, which manufactures the API, saw its volumes of ibuprofen decline by 1,200 metric tons in Q3 of FY22, and ibuprofen API prices, which were once sold at around $16 to $18, fell to around $10 to $12 levels. More so, companies such as Solara then faced a lethal combination of low demand of ibuprofen APIs and rising pressure from input costs, thereby impacting their margins. Input costs rose from critical raw materials to solvents such as IBB and sodium dichromate, and logistics, freight costs, all of them saw a spike. So where do things stand currently? Solara's Q4 numbers improved quarter on quarter, but it was still impacted by a weak ibuprofen demand in terms of global markets. Realizations stood at around $12 per kg versus $16 in FY21. However, companies have indicated that their order book for ibuprofen is much better than it was in the past 2 to 3 quarters, with inquiries now rising. Solara is confident of demand recovery in regulated markets. Lastly, the street will watch out for a recovery of realizations to earlier prices, and finally stabilization in input costs as well, especially in the wake of the recent geopolitical tensions and rising COVID-19 cases in China.
All right, Ekta, thanks a lot for that insightful discussion there. We also have Aditya Khemka with us, but just before we go to him, those are UPL's numbers at the bottom of your screen. Revenues have been over 15,800 crores. That's a near 1,000 crore beat on the company's top line. The EBITDA too has been a beat to the same tune as the revenue. In fact, 3,400 crores in terms of the EBITDA, and because there's been an equal number of beat or an equivalent amount of beat on both the revenue as well as the EBITDA, the margins have come in at 21.4%. Remember, these are margins which have been adjusted for forex related expenses or gains. So 21.4% is above what the in terms of margins is largely in line, but the absolute number is above what the street was working with, and that's primarily because the revenue has been a beat as well. However, the net profit though is again in line on an absolute basis with what the street was expecting. So we'll just try and get in some more internal details out there with regards to finance costs or maybe an other income or tax sort of impact that may have come by. But from the looks of it, the three numbers that we have access to right now, the revenues have been above estimates. The EBITDA at an absolute level has been, okay, we will just try to, adjust the EBITDA for the forex impact as well. But as we do that, let's go to Aditya Khemka, who's the fund manager, head healthcare portfolio, In-Cred, joining us now. Aditya, always a pleasure speaking with you. You've heard Ekta on the ibuprofen impact for the industry. I remember the last time we had a conversation, you said that, post-COVID, a lot of the companies that benefited from COVID will now not benefit, but a large part of the pharmaceutical industry did not really benefit from COVID. Where do things stand now as you see them?
So thanks for having me on the show. So I think there are companies which are eventually recovering from the COVID impact, So we saw some of the domestic companies reporting domestic sales growth of 30% plus in FY22. And that basically reflects the low volume base of FY21, which was impacted due to COVID, and FY22, which is relatively less impacted due to COVID. So clearly, there is recovery in the companies in the non-COVID business. And wherever companies did benefit from COVID are seeing, some declines in the COVID-related revenues. Classic example, diagnostic companies. So we are seeing their COVID sales falling and non-COVID sales recovering. So clearly, there has been the trend as we expected, where companies which got adversely impacted from COVID are recovering, and companies which benefited from COVID are partially getting impacted because COVID sales are not happening as much as they were happening before.
Okay, all right. That point is taken, Aditya. But do you expect this whole China +1 factor to play out sustainably? Because there are talks of it re-emerging simply because of the kind of zero policy that China has. And that's, making MNCs or global pharma companies rethink their strategy again.
No, so I think clearly the China +1 strategy is playing out. See, basically, if you were a customer of China, Chinese API or Chinese raw material, think of all that you have gone through over the past 2 years, right? You have seen multiple price escalations. You have seen supply disruptions due to ports being shut. And you have seen significant, issues in terms of consistency of supply. Now, these are things which we believe are very, very dear to the big pharma companies. They don't care about the prices as much, but they do really, really care about the consistency and quality of supply. And, such disruptions, when they happen, change the strategic outlook of these companies. We have seen statements coming out from various big pharma companies that they are clearly looking at a China +1. And if you look at the domestic API companies, look at how they are expanding capacity, look at how they're preparing themselves for that order inflow. That clearly indicates to us that China +1 is playing out. Obviously, certain products we cannot compete with China. For example, fermentation-based products, China has a definitive advantage there in terms of scale and technology. But in other product segments where we are competitive compared to China, that China +1 is definitely playing out.
Okay, all right. So that's the expectation. But Aditya, what about larger companies such as Divi's? Because at one point in time, COVID was expected to be the biggest opportunity for them. And that might not be the case anymore, simply because the expectation or the utilization of the drugs themselves has probably reduced versus expectations. So what is your sense? How would you approach a stock such as that? I know you can't talk specifically about stocks, but say the large cap companies which had these kind of COVID-19 opportunities.
Sure. So Divi's did benefit, to an extent from COVID, but you have to understand Divi's evolution, right? So Divi's was a company born in 1982. Right up to 2018, Divi's total gross block was about 1,800 odd crores. And as per the Divi's management, by FY23, their total gross block will be 7,000 crores. What that tells you is that over 36 years of their existence, they spent 1,800 crores to create capacity. But in the next 5 years, they're choosing to spend 5,200 crores alone in 5 years to create capacity. So clearly they have a visibility in the order book that they can utilize such a capacity. Otherwise, it doesn't make sense to create that kind of capacity. So Divi's is a very, very large company. A very small part of the business did benefit from COVID. But the other products that they sell, they're in many cases the most cost competitive supplier for those products in the world. And I don't see them sort of, significantly getting impacted through this COVID, on and off. They will actually benefit from their vertical integration, their relationship with their customers, their chemistry skills. I mean, these are the core competencies of Divi's. And I don't see any of these competencies wavering in the near future.
Okay. All right. I want to move away now from this entire API story, Aditya, and I'm going to ask you about Thyrocare because they held this conference call on Friday evening, and that seems to have stirred up sentiment, at least on the negative side. That's what the stock is indicating. Did you hear the call, and what were probably a couple of the key takeaways? Do you think that pricing is just going to get more aggressive and hence margins probably won't recover for a company which used to do 40%, 50% margins?
See, Thyrocare, under its new parentage and new management, is going through a evolutionary process. Thyrocare used to be a predominant B2B business. Now, after pharmacy has acquired it, Thyrocare seems to be evolving to a B2C business. Now, if you compare Thyrocare margins to the other B2C, diagnostic labs such as Dr. Lal or Metropolis, what you would realize is that Thyrocare was at very, very high margins because it was purely B2B and did not have a B2C cost. Now with pharmacy coming in, Thyrocare has beginning to incur the B2C cost, but it has invested in the B2C infrastructure. It has not yet seen the ramp up of the B2C revenue. B2C still for Thyrocare is pretty small when compared to Dr. Lal and Metropolis. So you have to give a company like that some time because they have made the investments upfront. These investments go upfront. But the revenue is sort of back-ended. They come after you have made the investments. So once the revenue from B2C starts to flow in, you will see margins basically, stabilizing, and you will see Thyrocare. So we are pretty optimistic about Thyrocare's future because we think the marriage between pharmacy, which is a strong front-end player, and Thyrocare, which is a strong back-end player, just makes strategic sense.
All right, Aditya, always a pleasure speaking with you. Thank you for joining in and giving us the outlook on the entire pharmaceutical space. But let's shift focus back